Hello. Welcome back to the continuing lecture on the ratio analysis. This is Dr. Jeff Holm. Now, in our last class, we discussed asset management ratios. We didn't discuss all of the asset management ratios, but at least we started on the inventory turnover ratio, right? So, I said in our last class, there are two ways to measure this ratio depending on the industry. So first one is if you are for inventory turnover ratio for the retail industry, right? So, and the retail's inventory turnover ratio is basically revenue over, so hard. Okay, revenue over average inventory. Yeah, it's average inventory, right? And also, what is average inventory? We talked about it. It's the beginning inventory. Please bear with me. This mouse isn't really the best thing to draw with. Beginning inventory plus ending inventory. Ending inventory divided by 2. Right? Of course, revenue divided by. Now, so this is retail's way of measuring this ratio. But again, when in retail, revenue is basically the price times quantity sold. Isn't that right? You remember that? Revenue is basically price times quantity sold. So in other words, it is denominated in price. Revenue is basically sales revenue is inevitably denominated in price. So the average inventory a number you use is also in price. It's in price terms, right? And that is one of the characteristics of the retail's inventory, because retail business's inventory consists of only the finished goods, and the finished goods have a price tag on it. That price tag is what? The selling price. In other words, the retail price, right? So the inventory can be represented or denominated in price terms, right? In other words, inventory of retail can be expressed in price, right? That's one thing about the retail. But manufacturing's inventory, last time we talked about that, in manufacturing's inventory is expressed all in cost, right? That's why in manufacturing, the formula changes to CGS over average inventory. Right? And then once again, average inventory is okay, it's CGS in the average inventory is beginning inventory plus ending inventory. I didn't have to spell it out, but I did. Divided by 2. And think about it. In manufacturing, all inventory is expressed in cost, right? And that's why you're dividing CGS, which is already cost, right? And it's the cost side of the revenue, right? That's the cost side of the revenue, right? And then it's the matching cost side, matching the revenue. So it's only fitting and proper to divide it by cost, right? Average inventory means average cost of inventory, right? So this is generally called manufacturing method, and this is called retail method. But even in retail, I told you in the last segment, video segment, if inventory, if the retailer had fire in his store or in the warehouse, and when they file insurance claim, then they will, of course, they will claim. The claim amount will be based on the retail price. They won't think about it. Nobody will want to deliberately get less than their commercial value of their merchandise, right? But then for tax purpose, right, when they are reporting for tax, then they will, even the retail would have to use the manufacturing's method. In other words, even the retail will have to express their inventory in cost. Okay? So then let's think about what this ratio means. Now think about it. An easy thought experiment would be something like this. Suppose you have your average sale for a month is $100,000, right? Your average sale for revenue is 100,000. Then your average inventory, monthly average inventory, based on your past experience, you won't need to carry more than $100,000 of inventory. Make sense? And you remember, inventory is not for free. I mean, first of all, inventory involves two types of cost, right? Remember that we talked about this last time. There's inventory carrying cost and warehousing cost, right? Warehousing cost is obvious. You have to pay for warehouse to keep your inventory. And an inventory carrying cost is something like insurance. You'll have to. So carrying too much inventory would entail unnecessarily uh, more cost than more cost than that absolutely necessary. So you would simply carry the inventory that would be, uh, or in this case, that inventory that you're carrying is called goods available for sale. And remember, in from the income statement, you saw that. But anyway, so that's the idea. If your average inventory per month is if your average sale per month is 100,000, your average inventory uh, doesn't need to be more than or less than about 100,000. But suppose your sale is during a particular month is your sale has been particularly good, right? Your sale has been, extremely, extremely good. Then what's going to happen? You're going to exhaust all your inventory. Make sense? Quickly, you're going to exhaust uh, your inventory. You will run down, right? Your inventory quickly. Suppose your sale was um, in a particular month, your sale was $300,000, right? $300,000. So that's 3 times the normal average monthly sale. Then what does this say about the inventory? Well, obviously you must have run down your inventory once already. So you must have called your supplier. You must have called the supplier and uh, ordered again. In other words, you must have replenished your inventory by making a second order. And you would, order again for about, $100,000 worth. And that second order, a second batch of inventory, ran down again, right? And to make 300,000, 3 times the average monthly sale, what does that mean? This replenishing, reordering, and replenishing the inventory happened 3 times, right? So that's what inventory turnover means. The inventory turnover ratio basically means how many times the the inventory replaced itself, right? So the higher the number, right? The higher the number, what does that mean? The higher the number, the better it is, right? Excuse me. So let me erase this and okay. And the way the inventory looks usually like this. So of course, the horizontal axis is the timeline. Vertical axis is the dollar, right? So dollar value, dollar amount, that means, the inventory level, right? So think about it. During any particular month, inventory, and this is dollar. So during a particular month, you begin the month, you begin that operating period with something left over from previous operating period or previous month. That's called the ending inventory of the previous month, right? Ending inventory. And that's ending inventory at time ending inventory at time 0, which is, beginning inventory time 1, right? Think about it. The ending inventory of uh, the last month is the beginning inventory of this month. And this is your monthly, let's say this is like, about 20K, right? And since your average monthly sale is $100,000, this is lacking. So what do? You order, right? You place an order for the difference, which is what? Uh, about 80,000, right? 80K, which is called what? Net purchase, right? Net purchase. So then you have, 100K to begin the month, and the whole thing is called what? This um, net purchase plus beginning inventory is called what? So the whole thing is called what? Isn't that called the GAS? You remember that? GAS. What do you think it stands for? Goods available for sale. Isn't that right? So then, suppose if it is just a normal regular month, uh, this inventory will draw down, right, uh, uh, to the level of ending inventory or 0 by the end of the month. By the end of the month, um, if you will generally have some inventory, or ending inventory could be 0, right? But during a very good month, where the inventory turnover ratio was 3, what does that mean? Um, uh, After, when you have like after the net purchase, and when you have, $100,000 of, GAS, you quickly ran down, right, that inventory. So you order again, right? So back to 100,000, and then you quickly ran down, right? So you ordered again another, 100,000, and then you quickly ran down again. By the end of the month, you either have some ending inventory left, right? That's called ending inventory at time 1. Ending inventory at time 1, or beginning inventory of time 2 at time 2, right? Or it could be 0, right? Right? That means, ending inventory is 0. But this is what it looks like. If inventory turnover ratio 3, this is what has happened, right? Makes sense? Okay. So then next. So think about it. If the higher the inventory turnover ratio, right, your inventory is very productive, right? You have, an item that is selling like a hot cake, right? Makes sense? And if inventory turnover ratio is low, very low, or what did I tell you? How do you know if your ratio is good or bad? Well, other than the liquidity ratios, you don't have like uh, the absolute threshold, but you have to compare it with the industry average, right? And if your inventory turnover ratio is higher than the uh, industry average, then good. But if your inventory turnover ratio is lower than the industry average, then you have to work hard to much harder to bring it. You have to think about what is wrong with your merchandise, right? Uh, it's clear that you're stuck with the merchandise that doesn't sell. So you have to seriously rethink uh, what kind of merchandise you should carry, right? Um, so next is fixed assets turnover ratio, right? And what is fixed assets turnover ratio? It's fixed assets turnover ratio. So let me. The name is already fixed assets turnover ratio. I'm not going to write it again, but that means it's revenue over fixed assets, right? But then you might wonder, uh, so why would you measure such a ratio? I mean, if it is inventory turnover ratio, that makes sense because inventory is something that, for a retail business, obviously, inventory is um, entirely what you can sell, right? What your business sells. So um, that makes sense. But fixed assets is not what you can sell. Why would you why would you bother with such a ratio? No, you don't sell your fixed assets, but uh, your fixed assets are plant and equipment. So your fixed assets are what your physical capital, right? And your fixed assets are what uh, churns out that merchandise, right? If and also fixed assets turnover ratio is especially uh, critical to the manufacturing industry because manufacturing industry has a lot of fixed assets, right? So this is a ratio that actually measures because you're not selling the plant and equipment, you're not selling the fixed assets, but you want to measure the productivity or efficiency of your fixed assets, right? Makes sense. In other words, you're trying to measure the efficiency of the contribution of your fixed assets to the revenue, right? Think about it. If your fixed assets are productive and efficient, right? It will generate a lot of revenue because it's going to uh, produce, churn out a lot of products, outputs, right? Which will turn into revenue, right? Because they will sell and then they will turn into sales revenue. So if your fixed assets have uh, churned out huge, on a large scale, huge, quantity of output, and uh, those outputs are sold, then think about it. Eventually, the revenue, it will generate more than enough revenue to pay for the fixed assets. Make sense? If the fixed assets are um, very productive, it will pay for itself. Now, even if it is not manufacturing, let me use another example, a service industry example. It still applies to any industry. Now, think about it. Suppose you are a lawyer, okay, and you have your own law office. I mean, you have your own practice. I mean, uh, you don't work for a law firm. You have your own law office, so it's you're self-employed. Uh, it's a sole proprietorship, right? Personal business, personal law office. So your product is legal service, right? And then Think about it. If your business is doing well, what does that mean? You have a lot of clients, right? And a lot of clients will generate a lot of revenue for you, right? And if you have, that means you are retaining a lot of cases, right, from a lot of clients. And if you have a lot of cases, what would you do? To win the case, you will have to research the cases, right? You'll have to and as you research the cases, you will have to use your computer. And you do basically online research, right? So you need a very good computer, that can that's has very high speed uh, modem. I mean, a high speed, memory chip, uh, high speed CPU, and large capacity RAM memory chip, and so on. And so let's say your computer is uh, your computer can be considered as your business's major asset, right? Um, Major asset. Now, so you research a lot of cases, and through the research, you win a lot of cases, right? So this is a very high scale, high quality upscale computer. So you must have paid uh, a lot of money for that, maybe $5,000 for this computer. And think about it. If the computer, uh, if you can do a lot of research, right? Because the computer is slow and it gets, it stalls a lot of times. Internet connection is unstable, and you cannot do a lot of research. And then you probably won't be able to win a lot of cases. If you don't win a lot of cases, then you lose your clients. If you lose your clients, then uh, you can't even generate enough revenue to pay for that computer. Makes sense? If you bought the computer with a credit card, then it's going to be even difficult to make $5,000 in revenue, in income, right? Uh, then you cannot even pay for your computer. Of course, you're the one paying for your computer, but think about it. If you use the computer to its maximum efficiency and to its maximum utilization, right, to maximum utility, and you win a lot of cases and retain a lot of clients, then the computer will work hard. The computer will work hard um, because you're using it a lot. Uh, so the computer will work hard, and it will generate uh, a lot of income, right? So if the sales revenue of this lawyer is $100,000 a month, right? Let's say a month, or let's say a year, even a year, right? Then from this revenue, uh, with this revenue, this computer can more than pay for itself, right? Makes sense. The computer can, with that, if it is 5,000, it can um, even $50,000. It can pay for uh, 20 times. It can pay for itself 20 times. So $5,000 computer can pay for itself even 2,000 times. I mean 200 times. I'm sorry, 200 times, right? So that's what it means, right? The computer can replace itself. The fixed asset can replace itself, right? Uh, uh, a huge X number of times, and that's what the turnover ratio means. Okay, so the higher this number, it means the more productive and the more efficient the fixed asset is. Okay, on the side, there's also, I mean, if we're doing only like two major ratios in each category. Um, But if I can mention the third ratio in this category, it will be total assets turnover ratio, total assets turnover. So then what does that mean? Total assets turnover ratio would be then revenue over total assets. Okay? And then you get the idea. That measures then how productive or how efficient your total assets are, right? Now, so if we, looking back, we talked about, inventory turnover ratio, but think about it. Inventory is what? It's part of the current assets, right? So inventory measures it's a representative of the efficiency of current assets. Of course, inventory is not the entire current assets, but it's just one aspect of current assets turnover, right? Ratio. And fixed assets, of course, non-current assets, right? So if you're looking at the inventory turnover ratio and fixed assets turnover ratio, you're pretty much, looking at the overall total assets turnover ratio, right? Okay, now then we move on to the debt management ratios. Fourth category is the debt management ratio. So in debt management ratio, the first one is times interest earned. And I told you in the last segment of the video that this times means literally, it has nothing to do with the chronological time. It means how many times, right? How many times. That's why I use this here, multiplication, right? Rather than, this is not X, it's multiplication, rather than T, right? So that means how many times the interest payment, right, have you earned? That's what it means. Okay, remember from the income statement, right? If you remember, or go back to the income statement, the interest expense is paid from what? Remember, if you subtract all the expenses from, right, CGS and OPEX, right, from the revenue, right, income, right, the result is called what? Operating income, or EBIT, right? You remember that? EBIT, earnings before interest and taxes, right? Now think about it. And then after EBIT, what comes next? From the name EBIT, it's already self-predicting, it's already self-forecasting, isn't it right? It's things before interest and taxes. So what comes next is interest, isn't it right? So that means interest is subtracted from what? EBIT, right? Your interest has to come from EBIT, right? So that means what? You must have at least enough EBIT to cover for interest payment. Make sense? So if you have earned just enough to pay for interest, then what does that mean? The EBIT is the same as interest, and in that case, if you take this ratio, then it will be just 1, right? And of course, you don't want this ratio to be just one. It should be greater than one. Not just greater than one, it should be many times, right? Multiple times, or one, or the number should be the higher the number, the better it is. Of course, once again, the industry average comes into play. So if this ratio is much higher than the industry average, your company is in a very, very good position compared to the average industry, right? Average of the industry. And if your times interest on ratio is lower than the industry, you're not good, right? And think about it. The meaning of this is, why do you have interest? You have interest payment because you have debt, right? And remember, there are two types of long-term debt. One, the bond, right? The second one is a bank loan, like mortgage, right? Of course, bank loans, mortgage will be paid through amortization, right? Remember, in amortization, you are making like installment payment, right? Payment in installment, like monthly payments, and each monthly payment um, uh, involves, right? It's comprised of, each monthly payment is comprised of partial interest and partial principal. So both principal and interest are paid at the same time. But if your debt comes mainly from the bond, and remember what bond is, a non-amortized. That means you don't pay the principal until maturity. You pay only interest until maturity, right? So think about it. If your long-term debt comes mostly from the bond, it's really crucial to pay interest. If you can't pay interest, that means what? You're defaulting on your debt. Defaulting on the debt can trigger bankruptcy, right? It can trigger bankruptcy, right? So it's quite crucial, and that's why it is also called debt services ratio, right? Debt servicing or debt services ratio, also called coverage ratio. Okay, coverage ratio or debt services ratio. Now, and the second ratio is total debt to total assets ratio. Total debt. Total debt means what? Long-term debt plus short-term debt. Both, current liabilities and I really current liabilities and non-current liabilities. Oh, it's so hard to write. Okay, I will. So that should be total debt. Yeah, this is terrible. But so it's obvious. I'm not going to write that anymore. But total debt to total assets. Okay, don't expect me to spell it out. And spelling out everything is very, juvenile. It's an elementary school thing, right? Using symbol is more mature thing, right? being able to understand total debt over total assets. Because, this is not a spelling class or English composition class, right? And then writing out everything, spelling out everything takes too much time, right? So that's why I'm saying it is not a mature thing to write out everything. People who are smart understands because the symbols, because symbols are like the drawing of the blueprint, right? You don't have to explain this is the first floor, this is the second floor, this is the door, this is the bathroom or back. You just put up, a floor plan, right? A blueprint of a structure of a machine or a building just by looking at the symbolic uh, representation of the blueprint. A smart person already grasps everything, right? Anyway, because there is certain regularity or consistency that can be found in a blueprint. For example, you use the same symbol for the door. You use the same symbol for staircase, repeatedly. So by looking at that, then you figure out, oh, this is the staircase. This is the door. This is the window, right? Things like that. This is the bathtub. This is the this means the oven top or but elementary school kids must be told everything, must be explained. Everything must be explained verbally, right? That is the but that's why I'm saying we're not doing that now. So this means total debt, right? Literally, total debt over total assets. But think about it. Then total debt or total assets would always be less than 1. Isn't that right? Think about it. Why? Because assets are debt plus equity, right? So that's why this is also called leverage ratio. Leverage. Leverage. And why? What leverage mean? Leverage means using debt, right? So, in other words, leverage is automatically telling you, revealing the capital structure of the company. Right? Remember, because this is another name for that is debt ratio, right? Which is also called leverage ratio. And the debt ratio, because total assets consist of debt and equity, if you know the debt ratio, then you automatically know the equity ratio, right? If the debt ratio is 40%, right, then what does that say about the equity ratio? That means the equity ratio is 60%. Make sense? Now, and why is it called leverage? Leverage, in everyday language, the word leverage is used very often to mean some extra boost, extra help. You get leverage, you get some leverage from this, or you leverage this out. What does that mean? You use, if you say leverage this out, uh, you using this as a leverage um, to multiply, amplify the result, right? But then, if you think about it, that all makes sense because when you use lever, you amplify or multiply the output. Isn't that right? If you use a lever and a fulcrum, you can lift you cannot even lift 100-pound weight, but if you use a lever and fulcrum, right, you can lift even a 10-ton boulder, right? Just like the old ancient Greek mathematician Archimedes famously said. I'm not quite sure if it was Archimedes or somebody else, but give me a lever fulcrum and a lever long enough, then I will lift the earth, right? Lift. So think about it. Using leveraging something means you're using something as a lever, right, for leverage and lifting something up, multiplying the outcome, multiplying the effect, amplifying the. But then, why is using debt called leverage? Well, because uh, this is something you will learn from the corporate finance. But using you might think using debt is not a good thing, right? Look at the if you look at the capital structure, and if you think if a company has no debt but 100% equity, you think that's a very safe, um, riskless company. Yes, it is riskless, that's for sure, right? Because there's no financial risk in that company. But then this company isn't maximizing its full potential, right? That's by using some debt, it could, even increases potential, right? Much higher to a much higher level. So that's why it's called, that means, then using more debt, using leverage, you can lift the earnings per share, you can lift, raise the return on equity, right? So that's why it is called leverage, right? You're getting the equity holders will get a benefit from using debt, right? Just like using a lever and fulcrum. That's what. Um, but if you now think about it, both of them, coverage ratio or leverage ratio, they are all about uh, something you should focus for, uh, to prevent potential bankruptcy. Because, as I said already, if you cannot pay interest, right, it can trigger a bankruptcy. Now, of course, you don't go bankrupt generally. You don't go bankrupt from the long-term debt. It's usually, the short-term debt, or which is in current liabilities, right? Or defaulting the interest payment. But at least looking at the long-term debt, right? You should be able to. Oh, of course, this is not just the long-term debt. This is the total debt. The higher this, the higher the leverage. I said uh, leverage is necessary. Leverage is essential in raising uh, in capital structure. Leverage is an important, very important tool to increase your earnings per share and raising your return on equity. But too much leverage, of course, is jeopardizing your business. Too much leverage will put you under a lot of financial distress, right? And too much leverage will completely dissipate all your um, EBIT by using it for paying interest. So your um, EBIT will be all dissipated in paying interest, and you will have nothing left, even for EBT, right? So that's an important. That's another reason you have to look at uh, the total debt to total assets ratio. Now, finally, we're moving on to the. So I'm going to clear this. Moving on to the market valuation ratio. The first one is price earnings ratio. Second one is market price to book value ratio. Yeah. We're going to need another session for really discussing in depth, but since we are running out of time, I'll just get uh, straight to you and uh, straight to the result. Now, this price means market price, right? And uh, you understand the difference between market price and book value per share, right? We talked about that. So, uh, and we can easily tell this is earnings per share, right? Earnings per share is what? Earnings per share is uh, whatever is called per share means you are dividing it by the total something per something. Per means you're dividing it by uh, something, right? So that means earnings per share is then what is earnings per share? Uh, what earnings are we talking about? Uh, EAT, right? The net profit, because that's what belongs to the shareholders, right? Or the equity holders. Then uh, per share means you're dividing it by number of shares, right? So what is that? That's literally the profit per share. If the company has uh, $1 million, a $10 million profit, or $10 million EAT, right? Earnings after taxes, right? And if there are 1 million shares outstanding, um, you want to know what is the profit or earnings per share. Well, then you'll divide it by right number of shares. But then why do you use this ratio? This ratio is actually another measure of output to input ratio, right? Output to input ratio. Remember the output to input ratio we talked about? Gas mileage is a good example of output to input ratio. But if you look closely, this is not output to input. This is their input to output ratio. Isn't that right? Why? Because earnings per share is your output. That's the benefit you reap from investing in the stock. Isn't that right? But then to invest in stock, you have to pay this cost. The price is the cost you have to pay, cost you incur uh, to reap this benefit, right? Or this is the input, price is the input to get this output. Get that? So this is rather than output to input ratio, this is the reciprocal of the reciprocal of output to input. So this is input to output ratio. But then think about it. If this is like inverse gas mileage, right? If in the U.S. gas mileage is miles per how many miles per gallon. So the higher the number, the better it is. But if the gas mileage, if you're using inverse gas mileage in a lot of countries, right? uh, other than US, uses inverse gas mileage, right? Why? In other words, they use uh, uh, how many liters per kilometer, how many liters per kilometer. Uh, so that seems counterintuitive for a lot of uh, people in the U.S., but they it also makes sense. Why? Because the lower the number, then in that case, the lower the number, the better it is. Isn't that right? To run 1 kilometer, if you use less gas, right, less liters, that's better. But for those countries, why do they use inverse gas mileage? Well, those are not oil producing countries. U.S. is a giant oil producing nation, right? Uh, you may have not realized it, but U.S. is has the most abundant oil reserve in the world, beyond Saudi Arabia, beyond uh, Russia, beyond UK and India, uh, Northern Sea, right? Brent, what they call Brent oil, uh, it was co-owned, I believe, with Norway. Um, so for countries, U.S., which has abundant oil, the input, the cost doesn't really matter, right? Uh, and only in the U.S., you can own 8-cylinder V8, 5,000 cc or 5-liter engine SUV. I mean, in all other countries, that's unthinkable, right? Such a gas guzzling um, dinosaurs. In other countries you can't see those gas guzzlers. They all have small cars that are very very fuel efficient, right? Especially European countries, right? Why? They are all sized like minis. Most cars are the sizes of minis or uh, uh, smart or Volkswagen Golf sized cars. Uh, Sometimes or Fiat 500, right? Those are the average sizes, car sizes in Europe. So for them, cost matters, right? So that's why they use, looking at, they use, inverse gas mileage. But look, so the same reasoning applies here. If you have the price earnings ratio means what? The higher this number, what does that mean? For its earnings power, the price of the stock is too high, right? I mean, think about it. If this ratio is 100, what does that mean? The price of the stock is $100, but its earnings per share is only $1, right? But if this ratio is 5, what does that mean? It means, uh, the price of the stock is $100, but the earnings per share is $20. The ratio will be 5 then, right? Which one would you prefer? Lower ratio, right? Don't you think? Yeah, the lower, the better. But it's not that simple because actually, even in academia, there are two camps arguing with each other. One camp is, the proponent of high price earnings ratio. The other camp is the proponent of the low price earnings ratio. They have, but again, we are out of time, so we cannot talk about that now. And market price to book value ratio, that's literally market price over book value per share. Okay, and think about it. If book value and the market price are the same, this ratio would be exactly equal to 1, right? And if the market price is greater than the book value, this ratio will be greater than 1. Otherwise, it will be less than 1. But in each case, think about it. Um, Book value and market price would be the same only when after the correction, right? In other words, if the market price, think about it. Um, Market price would be if there is a positive expectations about this company, the market price will be greater than 1, because the market price will be greater than the book value, right? If there's a negative expectations about this company, market price will be less than the book value, right? Then the rate will be less than 1, right? So this ratio uh, is generally used as uh, a measure of overvaluation or undervaluation of the stock. So uh, that we're out of time. That's it. So we'll continue in the next lecture. We'll actually do um, uh, the exercise of this ratio of variables in the next lecture. So see you then. See you in the next segment. End of video.